This is Equity Investor with Julia Lee.
Welcome to the program. I'm Julia Lee from Bell Direct, and on tonight's show, a spotlight on materials. We discuss valuations, Aussie dollar impacts, as well as future predictions in this space. Plus, we'll answer your burning questions on Reliance Worldwide, G8 Education, as well as some other stocks on the market. And in our stock in a minute, Scott Phillips from the Motley Fool shares his pick and why he thinks current prices should be a strong buy. Don't miss it. And my guests tonight are Kim Slater from County Securities and also Lawrence Parker-Brown from COSEC. And you can also reach us at eq@skynews.com or hashtag Equity Investor. And don't forget, if you want to ask your question live on air, just include a contact telephone number and we'll ring you right back. But let's kick off the show with Spotlight on Materials. Well, spanning exploration, development and production of raw materials, the materials sector includes mining, refining, chemical products and forestry. Look, this is a cyclical sector which is heavily influenced by the global growth outlook. But over the past 52 weeks, the materials sector is up by 9%. And it's the key reason why the Australian share market is seeing earnings growth of about 8% at the moment. The best performing company in this sector was Pilbara Minerals, up 107%. And surprisingly, the worst performing has been Fortescue, down 38% in the last 52 weeks. So what's important when analysing companies in this sector? Let's start by asking our panellists. Kim, looking at the materials space, what do you look for?
I think the overlying trend in materials is what's happening with commodity prices. And as we know with commodity prices, they don't necessarily all move lockstep, although there is a synchronicity between them. So what you have to be looking at is where commodity prices are in the cycle. And I think the next thing that's also important is where the relative currencies are too. So where the Aussie US dollar exchange rate is. A great example was 3 or 4 years ago when we saw iron ore prices were at their nadir, and we had the federal government doing its budget forecast on $35 a tonne. Well, it never got there, but now we've actually got a very, very robust export business in iron ore with the likes of BHP and Rio.
And currency is a strange one, isn't it? Because it impacts the underlying commodity price. Correct. Because most commodities are traded in US dollar terms, but then also because miners are exporters, they translate international earnings back into Aussie dollar terms. So what exactly is it that you look for in terms of commodities? And
well, I think the other important thing you look at apart from the exchange rate is what the cost buffer is. And despite the fact that Fortescue is down 38% in price, it's probably the most efficient producer of iron ore that we've seen. I think it's got its all-in costs down to about $14 US a tonne, ridiculously low. But it's on the other hand, it's selling a grade of iron ore which is not as good as BHP and Rio, and it's suffering from that discount.
So Lawrence, bringing you into the conversation, we've talked a little bit about the supply, demand dynamics, the Aussie dollar impacts, the underlying commodity. What's the number one thing when you're looking at stocks in this space?
Well, great question. There's a lot of choice. It's a broad church. You can have pure plays where you're really tying yourself to one particular commodity. There are diversified miners. And there's a few on the periphery, for example, Amcor and Aurora, that are kind of a bit more industrial in their nature. So there's a lot of moving parts to each of them. And one of the things that I think retail investors want to think about is that there are cost implications, that there's capex, so that they often hold a lot of debt. But I think in this year where people are talking about the headwinds for the banks, I think for a short-term position, people have looked at it as a yield play as well. I don't think that's sustainable for a long time, but they are cash rich.
I beg to differ on that point because we've been speaking here for quite a few months now how I think BHP and Rio at least are two stocks which can replace the banks in the short to medium term as both dividend performers and capital growth stocks, and they're both doing exactly that, simply because the way the businesses are being managed, where capex out is very, very important, and any shareholder or any profits that are coming to the bottom line are being distributed to shareholders rather than just pumped back into mining projects.
And I guess the other thing that we should mention is that companies within this space are at very different parts of their own business cycle.
Correct.
So if you're an exploration company, it's dependent on sort of the drilling results and the results you have while exploring. Production is probably on cost of production, and perhaps if you have some extra development success and
You've got no
increased
royal
mine
commissions in mining anyway, which makes the investment landscape a little bit easier to deal with.
Bringing it back to, I guess, the important question for our viewers, your favourite stocks in this space. Do you have a favourite in the materials?
I like a few. The one that I think I'll showcase today is BlueScope. So BlueScope Steel is a different type of play, and what's interesting here is it's had a long listing history. It was really cheap many, many years ago, and there's a question mark whether you'd still be able to hold your shares in BlueScope. And I think on a technical level, it looks like it's at something approaching support. It has regulatory concerns, and the tariffs at the moment make this a question mark. But I think they've diversified across domestically and also the US potential to earn. So it's a business that I think potentially has some upside. So I quite like BlueScope.
And I guess the beauty of BlueScope is that, usually steel itself is seen as a commodity because there's not much differentiating the final product. But BlueScope differentiates its product. It paints it in a powdered form, and
so they have not only a number of different products that they can offer the market. Around $21, I think there's some broker targets that will give it considerable upside. I think Goldman Sachs have it around $21.
And Kim, I can see you giggling. Why are you laughing?
Not really, Jude. But I'm just sticking with the consistency of my view, which is the major resource stocks, which is BHP and Rio, because I still think that there's more rewards to come to shareholders in the forms of buybacks and higher dividends. And the way the commodity cycle's moving, particularly with where the Aussie dollar's going, I can see that currency is going to be the next impetus push in the capital growth of these stocks. And I really think that BHP's got the big numbers are for.
Okay, so this is where most of the earnings for the ASX 200 is coming from. Lots of exciting ideas coming from both our panellists today. It is time for our first email, and this one comes from Amelia. She asks, Reliance Worldwide has been sold off since announcing their results. Do you think there is more sell-off to come, and what entry price would you look at? So we're looking at plumbing parts. In particular, they have a product which is mostly sold into the US at the moment, which cuts down the time that plumbers need to be working on fitting in pipes and things like that. So there's, I guess, a structural tailwind there that's helping Reliance, but it's also taken over a big company over in the UK as well. But recently disappointed the market with its guidance. Lawrence, looking at Reliance Worldwide, I mean, still up 48% over the past year from that chart behind us, but down just since reporting season. What do you make of Reliance?
Sure, I think as it's a bit of profit taking. It's run really hard since listing in 2016. That earnings overseas, particularly in the United States, is quite attractive. I think Bell Potter have a price target now of $5.70. I think if you like the story, and we've liked it for the last sort of 12 months, it probably is time to sort of look at it. So it's on that retracement. I think it could be the case that the market sort of felt it run beyond justifiable forward earnings, but business with some USP, as you say, that shark bite seen by people that are far smarter than me when it comes to plumbing, that actually use the equipment as being, the best of its class as a sort of device. So a business that I think has a long future and potentially want to accumulate.
I mean, I love the idea. If you're a plumber and you want to do as many jobs as you can, if you can double the amount of jobs that you do in a day, you're going to bring in more money. So that's what the product's all about. But on the flip side, plumbing parts, surely they'd be cyclical and tied to the housing market. And at the moment, you are seeing a bit of softness, not only in Australia, but over in London and some of the other major capitals.
Well, the interest, and you do display a significant knowledge of plumbing there, Julia. I'm very impressed. But I think the other thing you've got to take into account is that, yes, it's the new housing market where a lot of these products are used, but there's also a renovation market, and there's typically lags between the two. As new housing starts going up, your renovations are lagging, and now what we're starting to see is a bit of a trade-off between those two markets. But this is an interesting stock which has really good management that has been able to execute quite a number of acquisitions, and that's been demonstrated by the share price. And I think it is certainly a buy on this on the retracement that's occurring. And I think some of the price targets that I've seen are $6.50, $7 a share.
Oh, wow. So both of our panellists
Yeah,
seem to like this one. I mean, one of the interesting things that I found from the update was that last year was a really great year that they found it quite difficult to replicate because of the cold snap over in North America, which saw a lot of the pipes cracking, so they had to be replaced, and obviously there was a greater demand for the product, and that wasn't backed up by the weather this year. So have a look at that colder weather in North America. It seems like they have a lot of old piping which tends to crack when the frost comes through. Our next email comes from Ben. He asks, would love the panel's thoughts on G8 Education and the extent to which it will continue to be impacted by oversupply. Do you think their balance sheet is an issue? Well, certainly the share price probably reflects that it is an issue. Kim, what about you? What do you think about G8 Education, childcare centres?
We know that there's a huge oversupply in the market, and that's been evidenced by the fact that some of the child education centres have been giving away free iPads to parents to try and get get them to put their kids in their childcare centres. So I can't see that that structural imbalance is going to be solved anytime soon. There's probably another 2 to 3 years pain, and when I start looking at share prices like G8, I'm just reminded of Eddie Groves, and there's an awful deja vu there, but I don't know. The share price is down 45%, so there's got to be something happen here with the structural supply. So there's either got to be either some of these education childcare centres needed to go out of business, or there has to be an amalgamation. A rationalisation.
I mean, it's probably just me, but I feel quite sad when I think about childcare centres or aged care centres which are listed on the market, because sometimes profitability maybe perhaps shouldn't be the same goal.
Yeah, good point.
And when you have staffing costs which are going up, especially with the ratios in these childcare centres, and you don't have the full vacancy, and you're looking at trying to make a centre profitable, well, where do you cut the costs? Often they can be quite essential items.
Well, it's interesting. I think there's a strike of childcare workers happening to Wednesday this week. 8,000 people going on strike because of the low levels of wages in that industry, and it is an endemic problem.
I think it's a business that there's a lot to dislike, in the sense that acquisitions, a roll-up strategy, there's, as you say, there's regulations about what sort of staffing ratios you can have. But the thematic probably attracts a lot of people. I think it probably is a business where you could trade it, but as a long-term investment, I think it's the sort of, as you say, it's an industry where you, as a shareholder, where do you want the profit to come from? Ideally, I suppose you shake out, as you've touched on, Kim, some of these smaller sort of cottage industries that might be regional and try and amalgamate. That's, I guess, the investment hypothesis.
Well, the problem is that the barriers to entry are quite low as well. I mean, you've got a building and you've got the childcare qualifications.
Well, that does take 2 or 3 years to get your licensing through for a childcare centre.
Possibly it does, but I mean, it's not the barriers are not that high for someone that wants to go into that industry. And as you say, there are a lot of smaller aspirants that are in that. But the issue is what do you do about oversupply? The only way to tackle that is there's either got to be more kids going into childcare, and we're not exactly...
Or less childcare centres.
Or less childcare centres, one of the two. And we're not exactly having the debate at the moment around population is that we should be possibly decreasing population rather than increasing it.
For me, the challenge comes when you have an industry that's financed so heavily by government spending.
Correct.
And you change the regulations. So the childcare rebate is now means tested, which means on the higher end at the premium centres, you're probably going to have kids that might be pulled out to have that full-time nanny because there's not a huge amount of difference coming through.
You've got the vacancy there.
And then on the lower income end, you probably have too much demand or increasing demand. So you probably have a need for new centres. So that shift and the subtle shift in the supply-demand dynamics, I would think, would be quite difficult to manage as a childcare operator like G8. But G8 Education, it has been under pressure in the past. The value of its stock has gone up on the back of acquisitions, but of course, that acquisitions probably aren't a driver anymore, and they're looking at that organic growth and reinvesting into their centres, which is a much more expensive proposition. Coming up after the break, the Motley Fool's Scott Phillips shares his pick following a reporting season, plus my favourite section, which is Lawrence and Kim's buy, hold and sells.
You're watching Equity Investor.
Welcome back. Now it's our stock in a minute.
G'day, I'm Scott Phillips from the Motley Fool. The stock I like is Bapcor, the company you might know better as Burson Auto Parts. Bapcor is now a much bigger and better business than it's been for a very long time, but the market has kind of forgotten how much it likes it. This is a company that was really popular, almost a fad stock, only 6 or 12 months ago, really lost favour in the wave of onslaught of electronic vehicles or EV cars. The market completely forgot about the company, but it continues to power on. Really strong results, really good guidance, and the company's going to open even more stores. It continues to upgrade the number of stores it's going to open and the range of products and, frankly, the types of businesses it can operate in. It's now in New Zealand, it's more broadly in Australia across multiple brands, including Burson, but other brands as well. This is a company that really has a very solid place and a very solid lock on its industry. Its localised warehousing and distribution is a really important part of its business, and we'll see Bapcor really deliver in the years ahead.
A great tip coming through from Scott Phillips from the Motley Fool, and just by coincidence we did see Bapcor shares hitting an all-time record high on the market. So can it continue? Let's find out what my panellists think today. I mean, Kim, who would have thought auto parts and services?
Well, particularly when you look at the rest of the auto parts sector and automotive holdings, and that there was a story I saw in the Fin Review this morning talking about how the wealth effect is going to impact on the sales of new BMWs. So, you know, here you have something which is bucking the trend, and I'm not quite sure why.
What do you think, Lawrence, of Bapcor?
Really interesting business. I think when we classify business, it's in that consumer discretionary, and it got sort of around 18 months ago, 2 years ago, people started to say Amazon, they're going to come in and you can get your car freshener with Amazon, which I think slightly misinterprets the business in the sense that they do have a retail-facing environment, but obviously it's that sourcing of parts which is so instrumental to their success. So I think 18 months ago, it's one of those stories where I think it was irrationally ignored, and as Scott touched on, it's run hard. I think it's a business that's it's a pretty steady eddy. I don't think it's going to have too much pressure in terms of losing market share. They're very sensible with their acquisitions and very disciplined. The only thing is, I'm not sure from where it is now, kicking up to $7.80 or $8, some of the price targets I looked at, I'm not sure I'd be leaping in now. I think you can be patient.
I guess the other thing is, you know, when you put your car in for a service and it needs certain parts, you don't ever question the price of it. So I guess in terms of a margin, it would be a pretty sweet business to be in. But as Kim mentioned, do we see the wealth effect coming through and people just don't service their cars as often? With housing prices coming through. So the next 52 weeks, it looks like could be interesting there. Time, though, for my favourite segment, and that's where we get our panellists buy, hold and sells. Lawrence, we'll kick off with you. What are you buying?
ResMed is the business that I thought I'd share. Obviously, so many people have such strong opinions already. A business where it reported reasonably well. And I think sometimes with CSL, for example, which I was honoured to be on 2 months ago, whatever it was, that was a pick ahead of reporting. I think if you're leaping in now, you know, CSL pretty fairly priced. I think it's a brilliant business. I think ResMed's probably one where it's got that tech optionality. They've recorded so many. And so for anyone that's not familiar with ResMed, the idea that sleep apnea is probably going to grow as an affliction all around the world, particularly in countries where there are mature markets. Yeah, sure. Age. So
and fat people.
That's what I said.
That's a beast. So there's a lot of drivers that make you think that there's further growth for the business. So I'm a big fan. 1560-ish. I think at 1670, that's the highest target I saw for brokers.
Well, ResMed hit an all-time record high on the market today. One of its competitors, Fisher & Paykel, did not. And, you know, ResMed has launched a patent.
Yes, they got. Legal
in the courts over in the US. So does that colour your view at all? They seem to be lobbying court actions against each other all the time.
Yes. So Fisher & Paykel is also a high-quality business in a similar space. ResMed's larger by market cap. It's also the business that's got greater market share and longer listing history. I think they can coexist. There is that challenge that both of them will feel that they want to protect their intellectual property. It looks like, I mean, I'm not a legal expert, that will to and fro probably for a number of years, and you know you can always appeal on the judgments, but I think you can be in both probably. I think they're good businesses.
Oh, okay. And Kim, what are you buying?
Sticking with the commodities theme, Julia, S32. A really quite an interesting business where, you know, manganese, thermal coal, although they are making moves to get out of thermal coal, but one where they are very efficient producers, good market share, and producing lots and lots of cash. I think the last count was about 1.4, 1.5 billion on the balance sheet, cash. doing buybacks, and I think we're going to see more dividend streams come through from the company as it continues to rationalise its business.
Okay, so South32 up 20% in the past year, and
It's always been an interesting one because every time it gets up to around $3.94, it's always banging its head on the ceiling, comes down to about that $3.30, $3.40 level, and then recovers again. So that it's a stock that is a favourite trading stock, but I think at these prices around it's about $3.50-ish. It's priced. It's priced for the upside, not the
okay, so
downside.
two very different stocks, South32 and ResMed. What are you selling today?
So in terms of selling, there's always different ideas floating around. One that I think is worth sharing with a lot of people if they've done well with the story is Ingham's Chicken. So Ingham's, its ticker code ING, is a business where I think structurally there are a few question marks about it. A monopsony provider that can only really retail to a handful of names. And the other thing to share is I think it could do well in the future potentially, but when you've got private equity that have been in the story for 3-4 years, they're looking to obviously have an exit strategy. So I just suspect if you've done well with Ingham's Chicken, there could be a block selling sort of story over the next few weeks.
Not to mention the drought. Feed prices are going up, so that will certainly take a bite out of Ingham's.
We were waiting for the pun, Julie. We were waiting for the pun.
Kim, what are you selling?
Off the back of a Telstra presentation last week, I had a look at it again, and I just think that Telstra, now it's in the threes, is starting to run out of steam. I think if you want to be in the telco sector, TPG is going to be the one with Vodafone. So I think there's still a lot of question marks around what Telstra's future business strategy is. They're trying to tell the market that they've got one, and I don't know that the market really believes that they do have one. There's still issues with the with the size of the NBN payments that are coming through. So to my way of thinking at these sorts of prices, I think Telstra's probably a sell more than a buy.
Interesting. I mean, everyone's got an opinion on Telstra, so what do you think, Lawrence?
Yeah, I think when it was really in the doldrums, I think a lot of people saw it as a trading opportunity. The run-up it's had is probably this notion that the ACCC might be in favour, potentially, of TPG and Vodafone, and therefore sort of shaking a few people out of the industry and really consolidating the market. So the idea that the margins for Telstra could improve. I think that's a logical hypothesis, but it's not enough for allocating serious capital.
Well, I think what possibly is going to happen is that Telstra's the elephant in the room, and all the other telcos in the market, like TPG, are going to be a lot more nimble, can move a lot more quickly on pricing. And we've always seen that Telstra's always slow to pick up on business trends, improve its pricing, and in customer service. So anyone that's had anything to do with Telstra lately would tell you that their customer service is still crap. So
putting on our CEO hats, what would cause you to buy Telstra?
If the price fell away again into the mid 250s, 260s, I think
just price it.
I think it is. Look, you've got to get paid for the risk. And until Telstra actually comes out with an ironclad business strategy that says we're doing this, this, and this, and it's still very much capex heavy, and until we start to see the cash flow benefits of that, I'm on the sidelines.
Interesting. We hope you've enjoyed the program tonight. A big thanks to my guests for a great show, Kim Slater from County Securities and also Lawrence Parker-Brown from COSEC. And a reminder that you can watch the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and of course if you're overseas we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general